Hello and welcome to part 2 of the lecture for chapter 11. So we'll pick up where we left off here. We'll make several entries whenever we record or we have a payroll. So that might be every 2 weeks, it might be the end of the month, whatever the timing is, but each time we pay our employees, we'll have these entries. The first one is to recognize the expense associated with employees. And again, it's a good idea to have multiple different accounts so we segregate that wage expense into, it might be marketing and production and all variety of different kinds of expenses. So we'll debit those two expense accounts. We'll credit the deductions that are made from the employee's paycheck. So all, 5 of those payables there, Social Security, Medicare, Employee Federal Income Tax, Retirement, United Fund, those are all amounts that are deducted from the employee's paycheck. So that leaves us with salary payable. In that case, that would be the sum of the amounts on the paychecks that are being handed out to employees or direct deposited for employees. Then we'll record employer payroll taxes. So the debit will be to payroll tax expense. Now this is the employer's portion of Social Security, the employer's portion of Medicare, and then the employer's responsibility for state unemployment and federal unemployment. So that will create the payables for the amounts that we're to remit to the government on a regular basis. So one of the objectives of a payroll system is one, of course, to pay employees accurately and timely. So I can tell you from personal experience in my own companies that employees will complain if you short them 5 cents on a paycheck. So pennies matter when it comes to payroll. So having it be accurate is important. Having systems in place that assure that accuracy is critical. And I would say timeliness is even more important. So making sure that you schedule to get your work done to gather the information that you need to be able to process payroll so that you can pay people on payday is really important. People will get a little irritated if you're off 5 cents on their paycheck. If you're a day late, they get really upset. So that's important. It's important that we meet all the regulatory requirements, that we're sending all the information to the government that we should. In some cases, that's state government. In all cases, it's the federal government as well. And then that we record information on a detailed enough basis that we can use the payroll information for management decision making. Seeing how we compare to budget, seeing what expenses are rising and falling, all of those kinds of things. So the payroll system is comprised of 3 elements. One is the payroll register. That's a listing of all the employees for a particular pay period, the hours they worked, their gross wages, all of the deductions, and their net pay. So it's an overview of a payroll. An employee's earning record is per employee, and you would look at, say, employee John Doe, and you would see all of the different paydays all the paychecks that person has received for each payday, and all of the details for that particular employee. And then, of course, we produce paychecks. In the old days, it was actual physical paychecks that were signed and handed to employees. Nowadays, it's generally direct deposit, and the employee gets a printout that shows this is how your payroll was arrived at and the amount that was sent in for you. There's some good examples of all 3 of those elements in the textbook. So the next thing I want to talk about are employee fringe benefits. So these are enticements to work in the company. So it's a way to retain employees, it's a way to attract employees, and it's something that the employer is not legally obligated to do. So in terms of, you're not legally required to give employees vacation or retirement benefits. With the Affordable Care Act, there are requirements to provide access to medical insurance, but at a reasonable price defined by the government, but not to pay for it necessarily. So the key thing about fringe benefits is to match revenues and expenses. So we want to recognize the expense in the period in which the employee earns the benefit. So we don't want to record the expense when they actually take advantage of the benefit. And vacation is a good example of that. You may have a policy that your employees earn 1 day of vacation for every month they work. Well, an employee may work January through June and not take any vacation. We would want to record vacation expense and vacation payable in each of those months. So then when they take their 6 days of vacation in July, we're recording the payment of a liability, not additional wage expense. So we're recording the full impact of of what the employee earns in the period in which they earn it. So that helps with proper matching. So a little bit more about fringe benefits. So there are two different types of retirement plans. There are defined contribution plans, which are the most popular. It's what you're most likely to find when you go to work somewhere, mostly private employers, and that's a 401k plan. So the employee, if they set aside a certain amount of money out of their paycheck for their retirement, then the employer matches that amount to some extent, either a 100% match or a 50% match or whatever, and there's usually limits. So that money is set aside in an approved investment vehicle, and the employee is not taxed on that money. They're taxed when they take the money out after they retire. So it's a way of moving some of your income out into your retirement years and gaining investment income on that over that time that's also untaxable. So that's the most common type of plan that you'll find, and in that case the company just recognizes pension expense when they record the payment. Defined benefit plans, on the other hand, are what you think of as a pension. So an employee works somewhere for a certain number of years at a certain wage rate, and that qualifies them to then receive benefits until they die, and in some cases it goes to their survivors as well. So that's once they retire. So that's a little bit more rare. Mostly it's very large employers, government entities that have that kind of defined benefit plan. If you work for the state of Washington, you can choose the option to have that defined benefit where you are paid a certain percentage of your salary depending upon how many years that you've worked there. The next topic I want to talk about are contingent liabilities. And contingent liabilities are liabilities that arise based on something that occurs this year, but we don't know for sure what we're going to pay in the future. So it's based on estimates. So a good example would be somebody slips and falls in my store, and I get a letter from their lawyer saying that they are intending to file a lawsuit against us. So the action, the slip and fall, happened this year, and we know about it. So we should, under certain conditions, record an expense associated with that and a liability associated with that. Another good example are warranties. If you buy or if you're selling a product and that product has a 1-year parts and labor warranty, then some portion of those products you're going to have to pay a claim on them. So in all likelihood. So in that case, you need to record an expense and a liability in the period in which you've made the sale to have proper matching. So there's two ways that we look at these kinds of contingent liabilities. One is the likelihood of actually having to pay money out. So either you probably are going to do it, it's reasonably possible, it might happen, it might not, or it's remote. And then measurement. Can we estimate how much we're going to have to pay, or is that impossible to do? So in the case where it is probable and we are able to estimate the amount, in that period we're going to record an expense, and in this case we're doing the warranty like I mentioned as an example. So we'll record warranty expense and a warranty payable this year. Now later when we pay a claim, we'll just be paying off that liability. We won't be recognizing a further expense, say, in the next year. If it's just probable but we can't estimate it, then we just disclose it in the notes to our financial statement. We say we got sued. It's probable that we'll have to pay something out, but it's too early. We have no information on what we might have to pay, so we disclose that to our shareholders. If it's possible, we disclose it in the notes to the statements, and if it's remote, we don't do anything. We don't record anything or disclose anything. And here's a visual example of what I just talked about. So we have some contingency that's occurred. We first determine what the likelihood is, and a lot of times that'll be done based on past experience or based on opinions of our attorney if it's a lawsuit. So that's how we'll try to get it as objectively as possible, determine what the likelihood is, although it is an estimate. If it's probable, then we'll determine can we estimate it or not, and that will then trigger how we record that particular event. Thank you very much. I look forward to talking to you when I lecture on Chapter 12. Thank you.